Hello students, welcome to RP Education class app. Hope you all are doing good. So let's start with the today's topic, that is balance of payment, free trade area, trading blocks and tariffs. So let's start with the balance of payment. Balance of payment is a statement which records all the monetary transactions made between residents of a country and the rest of the world during any given period. This statement includes all the transactions made by individuals, corporates, and the government and helps in monitoring the flow of funds to develop the economy. Also, balance of payment of a country indicates whether the country has a surplus or a deficit of fund. That is, when a country's export is more than its import, then BOP is said to be in surplus. On the other hand, BOP or balance of payment deficit indicates that a country's imports are more than its exports. So, there are mainly three components of balance of payment. First is current account. Current account is also known as the balance of trade. It accounts for the major portion of balance of payments as it contains transactions pertaining to the exchange of goods and services entailing monetary transfers. Next is capital account. All capital transactions between the countries are monitored through the capital account. Capital transactions include the purchase and sale of assets like land and properties. The capital account also includes the flow of taxes, purchase and sale of fixed assets, etc. by migrants moving out or in a different country. There are mainly three major elements of capital account. First is loans and borrowing, investments, and foreign exchange reserves. Third element of balance of payment is financial account. The flow of funds from or to foreign countries through various investments in real estate, business ventures, foreign direct investments are monitored through the financial account. This financial account measures the change in the foreign ownership of domestic assets and domestic ownership of foreign assets. So this is called financial account. Next is international liquidity. International liquidity is defined as the aggregate stock of internally acceptable assets held by the central bank to settle a deficit in a country's balance of payments. In other words, international liquidity provides a measure of a country's ability to finance its deficit in balance of payment without restoring to adjustment measures. The need of international liquidity arises because the demand for international liquidity is rising more than its supply, thereby implying shortage of international liquidity. The principal cause for the shortage of international liquidities are: first is BOP deficits. There have been increasing BOP deficits of the majority of countries in the world. In a particular, after the opening of less development countries to world markets, these countries have been facing persistent BOP deficit. Next is high tariff barriers. The exports of less development countries to developed countries have not been increased, thereby adversely affecting their export earnings. One of the reasons for the non-expansion of their exports has been high tariff barrier imposed by the developed countries on their exports. Next is unequal distribution of international reserves. The distribution of international reserves is biased and favors the developed countries. It is primarily based on their quotas in the IMF, that is International Monetary Fund. Whenever IMF quotas are revised, the larger share goes to the developed countries. Next is free trade. International trade that takes place without barriers such as tariff, quotas, and foreign exchange controls is called as free trade. Thus, under free trade, goods and services flow between countries freely. Then next is trading bloc. Trading blocs are the groups of countries who form trade agreements between themselves. So trading bloc also include three types. First is free trade area, where no tariff between the member countries. Also, there are no external tariff and can negotiate on trade deals. This is called free trade area. Next is customs union. Here also no tariff in between the countries, also no border checks, the common external tariff and trade deals for whole custom unions are same. Next is single market or economic union. Here also no tariff in between the countries member and common external tariff, and also free movement of goods and people in between the member countries. Trading blocs are important for world trade with a growth in the influence of regional trading blocs. They have advantages in enabling free trade between geographically close countries. This can also lead to lower prices, increased export potential, higher growth, economies of scale, and greater competition. So now we will discuss about different trade blocs around the world. First is European Union. The most integrated trading bloc is European Union. The EU 27 have free trade and common regulations and are part of the customs union. Next is NAFTA, that is North American Free Trade Association, a free trade area between Canada, US and Mexico. Next is ASEAN Free Trade Area. The Asian Free Trade Area in Southeast Asia, founded 1992, includes Brunei, Indonesia, Malaysia, Philippines, Singapore, Thailand, Vietnam, Laos, Myanmar, and Cambodia. Next is SAFTA, South Asian Free Trade Area based around the Indian subcontinent, includes Afghanistan, Bangladesh, Bhutan, India, Maldives, Nepal, Pakistan, and Sri Lanka. Next is Mercosur, a Southern American trading bloc formed in 1991, includes full members of Argentina, Brazil, Paraguay, Uruguay, with associate members including Bolivia, Chile, Colombia, Ecuador, developed from free trade area to become customs union. Next is African Union. 55 countries of the countries of Africa created to forge closer political and economic ties. It has aspirations to become a free trade area. So these are the common types of trading bloc around the world. Next is protectionism. A protectionist trade policy allows the government of a country to promote domestic producers and thereby boost the domestic production of goods and services by imposing taxes or otherwise limiting foreign goods and services in the market. So that protectionism, also called as restriction trade. Protectionist policies come in different forms that includes tariffs. The taxes or duties imposed on imports are called as tariffs. Tariffs increase the price of a imported goods in the domestic market, which consequently reduce the demand for them. Next is quotas. Quotas are restrictions on the volume of imports for a particular goods or services over a period of time. Quotas are known as non-tariff trade barrier. A constraint on the supply causes an increases in the prices of imported goods, reducing the demand in the domestic market. Next is subsidies. Subsidies are negative taxes that are given to domestic producers by the government. They create a discrepancy between the price faced by consumers and the price faced by producers. Next is standardization. The government of a country may require all foreign products to adhere to certain guidelines. For instance, the UK government may demand that all imported shoes include a certain proportion of leather. Standardization measures tend to reduce the foreign products in the market. So the protectionist adapts different policies to encourage domestic investment. To know more about the different causes, advantages and disadvantages of protectionism, kindly go through the RP education notes on page number 34. So now I will discuss more about tariff. A tariff is a duty or tax imposed by the government of a country upon the traded commodity as it crosses the national boundaries. Tariff can be levied both upon exports and imports. The tariff or duties imposed upon the goods originating in the home country and scheduled for abroad are called as the export duties. Similarly, opposite of export duty is import duties. Tariffs are several types and these can be classified into different groups and subgroups. So first is classification on the basis of criterion for imposition. Under this, first is special tariff. Special tariff is the fixed amount of money per physical unit or according to the weight or measurement of the commodity imported or exported. Such duties can be imposed on goods like weight, rice, fertilizers, cement, sugar, cloth, etc. This is called specific tariff. Next is ad valorem tariff. Ad valorem tariff is the Latin word that means on the value. When the duty or taxes is levied as a fixed percentage of the value of the traded commodity, it is called ad valorem tariff. Such duties are levied on the products the value of which is disproportionately higher compared to their physical characteristics such as weight or measurement. Next is compound tariff. The compound tariff is a combination of specific and ad valorem tariff. The structure of compound tariff includes specific duty on each unit of the commodity plus a percentage of ad valorem duty. So this is called ad valorem tariff. Next is sliding scale tariff. The import duties which vary with the prices of commodities are termed as sliding scale duties. This may either be on specific or ad valorem basis. In practice, these are generally on the specific basis. Next is classification on the basis of purpose for which tariff is imposed. First is revenue tariff. The tariff which is imposed primarily for generating more revenues for the government is called the revenue tariff. Next is protective tariff. The tariff may be imposed by government to protect the home industries from the cutthroat competition from the foreign produced goods. The higher the tariff, greater may be the protective effect of tariff. A perfect protective tariff is likely to prohibit completely the import from abroad. Next is classification on the basis of discrimination. Under this, first is non-discriminatory tariff. If the uniform tariff rates are applicable to all the commodities irrespective of the country of origin, these are known as the non-discriminatory tariff. Next is discriminatory tariff. In case of discriminatory tariff, the varying tariff rates exist for different commodities. The products originating from favored country are subject to a lower tariff rate than those of other countries. So this is called discriminatory tariff. Next is classification on the basis of products. First is import duties. If the home country imposes tariff upon the products of a foreign countries as they enter its territory, the tariff is known as the import tariff or import duty. Next is export duties. If the products of a home country become subject to tax as they leave its territory to be sold in the foreign market, the tax or duty is called as the export tariff or export duty. So students, this is all about the today's topic that I want to discuss through this video. In the next video, I will discuss on various pricing method in international business. If you have any doubt or queries, let me know by comment here or on WhatsApp group. RP Education is always with you. So stay tuned with us. See you in the next video. Thank you.